Welcome to the video. Today we'll unpack why many young investors, especially couples in the wealth building phase, may not need an ongoing financial advisor, and how recurring fees can quietly cost hundreds of thousands over time. We'll also explore why disagreements about hiring help often point to a communication issue rather than an investment issue. Then, we'll provide a simple, disciplined plan using low-cost index funds, global diversification, and clear spousal communication. Finally, we'll cover when it actually makes sense to hire a fiduciary advisor, what fee models to avoid, and exactly what questions to ask. Next, let's review our agenda. Here's the roadmap. First, we'll contrast the myth of needing an advisor with the math of compounding fees. Next, we'll quantify how a seemingly small fee can compound into a large dollar cost. Then, we'll reframe the common advisor debate as a couple's communication challenge and show a practical DIY plan for indexing and diversification. After that, we'll identify when hiring makes sense and exactly what type of advisor to choose. Finally, we'll quiz your understanding and wrap with clear action steps. To start, a quick disclaimer. Disclaimer. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Everyone's situation is unique, and you should consider consulting a fiduciary, fee-only professional for personalized guidance. With that established, let's move into the core idea: the difference between the myth and the math. Many investors assume they need ongoing professional management, but the evidence shows that broad market, low-cost index funds are already a robust, research-backed approach. A common misconception is that a 1% annual management fee is minor. Yet, over decades, even a small fee compounds into a significant reduction in ending wealth. Moreover, couples often seek an advisor to resolve uncertainty, when the real issue is a lack of aligned goals and risk tolerance. With that framing, let's quantify the impact of fees. In this simplified example, a couple starts with $100,000 and contributes $12,000 annually for 30 years. If their gross return is 7%, the ending value is approximately $1,894,762. If they pay a 1% assets under management fee, lowering their net to 6%, the ending value falls to roughly $1,522,949. The difference, about $371,813, illustrates how small annual fees compound into very large dollar costs. These numbers are illustrative. Pre-tax, ignore trading and other expenses, and assume consistent returns. Nevertheless, the takeaway is clear. Compounding fees can easily cost hundreds of thousands. Next, let's connect this to the relationship dynamic. This flowchart starts with a couple considering an advisor. If their needs are basic, using broad index funds, automating contributions, and rebalancing, they can proceed confidently with a do-it-yourself approach. If they have complex needs like equity compensation, multi-state taxes, or estate planning, it suggests a limited-scope relationship with a fiduciary on an hourly or fixed-fee basis. If they simply want behavioral coaching or plan validation, a one-time flat-fee fiduciary session may suffice. Finally, any path encountering a commission-based advisor or one who cannot confirm fiduciary duty triggers a clear warning to avoid. Next, let's address the real root cause of many disagreements. Communication. Disagreement about hiring outside help often points to misalignment on goals, timelines, risk tolerances, and estate preferences. The remedy is to create a simple one-page joint investing policy that lists goals, timelines, contribution targets, target asset allocation ranges, and rebalancing rules. This document turns feelings into numbers so both partners can refer to the same policy during market turbulence. Education and a shared plan foster harmony more effectively than chasing complex stock-picking strategies. Next, let's build a practical DIY plan step by step. Here is a concise do-it-yourself plan. First, prioritize tax-advantaged accounts such as 401ks, IRAs, and HSAs. Next, automate contributions to align with each paycheck and increase them whenever your income rises. Use low-cost total U.S. market and total international index funds as your core holdings. Choose a target allocation, such as 70% stocks and 30% bonds, consistent with your age and risk tolerance. Rebalance either on a set schedule or when allocation bands are breached. Maintain a cash buffer for near-term needs while keeping the long-term portfolio invested. Write a one-page plan that documents goals, allocation, contribution levels, and rebalancing rules. Review the plan annually as a couple and keep a log of decisions and reasoning. Finally, avoid performance chasing. Keep the focus on cost control, tax efficiency, and consistent behavior. Next, we'll clarify when hiring help actually makes sense and what type to choose. On the left are traits to seek. A fiduciary, fee-only advisor who charges a flat hourly rate or a fixed project fee clearly explains their investment philosophy and offers one-time or periodic checkups rather than insisting on ongoing asset-based fees. On the right are red flags. Commission-based compensation structures, charging a percentage of assets for simple indexing, product sales incentives, and vague claims of consistent outperformance. Next, let's spell out the exact questions to ask any prospective advisor. When interviewing advisors, insist on written, continuous fiduciary duty. Ask exactly how they are compensated and confirm that it is flat fee or hourly. Verify they do not sell products or receive commissions. Request a clear description of their investment philosophy and a detailed list of services included and excluded. Finally, ask if they offer one-time plan reviews so you can avoid unnecessary ongoing fees. Next, let's visualize the couple's communication workflow. This sequence diagram shows partner A initiating a money meeting and partner B agreeing. Together they list goals, timelines, and risk tolerance, then co-create a one-page plan. They set automatic contributions and schedule brief quarterly reviews. Throughout, a shared note emphasizes replacing feelings with numbers by referring back to the written plan. Next, let's ensure the portfolio has proper global diversification. A resilient portfolio pairs a total U.S. market index with a total international index, optionally including both developed and emerging markets. Bonds, whether U.S. or global, provide stability. Adhering to allocation bands and rebalancing methodically improves the odds of staying invested. The expected outcome is a smoother experience and fewer emotionally driven mistakes across market cycles. Next, let's look at a quick table comparing fee models. This table compares fee models. Flat hourly and fixed project fees are suitable for targeted or comprehensive but finite needs. Asset under management fees may be justified for complex ongoing engagements, but are expensive for basic index portfolios. Commission-based models carry inherent conflicts because compensation depends on product sales. Next, let's check your understanding with a quick quiz. Quiz time. Question: which advisor setup best aligns incentives for a couple who uses simple index funds but wants occasional guidance? Options: A. Commission-based advisor selling funds. B. AUM-based advisor at 1% annually. C. Flat fee or hourly fiduciary for one-time reviews. D. A friend's stock tips. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. A flat fee or hourly fiduciary aligns incentives, avoids ongoing percentage-based fees for basic indexing, and delivers targeted help only when necessary. Next, another quick question on communication. Second quiz. Question: if partners disagree about hiring an advisor, what is the best first step? Options: A. Pick the partner who's louder. B. Day trade to prove who's right. C. Draft a one-page joint plan clarifying goals, risk, and rules. D. Ignore the issue and hope it goes away. You may pause the video now to think about the answer. We'll discuss the answer in the next section of the video. The correct answer is C. Drafting a one-page joint plan is the best first step because it aligns the partners on goals, risk tolerance, and process, replacing emotion with structure. Next, let's provide a concise markdown-style cheat sheet you can reference. Here is a concise checklist in bullet form. Choose a target allocation such as 70% stocks and 30% bonds using total U.S., total international, and bond funds. Automate contributions and increase them with each raise. Rebalance semi-annually or when allocation bands are breached. If interviewing advisors, ask whether they are fiduciaries in writing, how they are compensated, and whether they receive commissions. Avoid performance chasing, sales pitches, and unnecessary asset-based fees. Remember that time in the market generally matters more than timing the market. Next, we will reinforce the fee impact with a simple data snapshot. This illustrative table reiterates the earlier example, starting with $100,000, contributing $12,000 annually for 30 years. The difference between a 7% gross return and a 6% net return is about $371,813. This is a simplified, pre-tax illustration and not a guarantee. The key point remains: ongoing percentage fees materially reduce long-run outcomes. Next, let's summarize the key points. Core takeaways. Low-cost indexing is an evidence-based approach. A 1% ongoing fee can accumulate into hundreds of thousands of dollars lost over time. Couples should first resolve alignment by writing a one-page plan and reviewing it regularly. If you hire help, insist on a fiduciary who charges flat or hourly fees and avoid commissions. Maintain global diversification and rebalance according to preset rules. Your primary advantage is time and consistent behavior, not stock picking. Next, we'll wrap up with a brief summary and a call to action. In summary, many young investors using index funds can confidently skip ongoing advisory fees. If you need specialized help, choose a fiduciary who charges flat or hourly fees. Write your joint plan this week. Automate contributions, include international diversification, and rebalance on a schedule. Protect your time, minimize fees, and allow compounding to work in your favor. Finally, here's a quick thank you and a call to action. Thank you for watching. If you found this helpful, please like, share, and subscribe. In the comments, let us know whether you plan to manage your portfolio yourself or hire a fiduciary for a flat fee checkup. Your feedback helps us create better content. See you next time.